Employee suggestion schemes. This is stuff that is quite weird. And the one after it, financial benefit awards, people forget about these things. You can give awards each month to employees that are tax-free. Great idea. We, as our own firm, have something like this. If you come up with a really brilliant idea, you get a bottle of champagne, which is worth around about £25, purely for tax reasons and not because it's a cheap champagne or whatever. That's the level at which you can give things away tax-free each month. Now, it's a small thing, but if you've got 30 plus staff and you bring this in, that small thing just shows that you're thinking about your staff. And again, it just changes that relationship between owner and employee. It's a very simple thing to do, but it actually has far more impact than the nominal sums may suggest. The bigger one is a financial benefit award. Now, if somebody comes up with a great idea that actually does provide a financial benefit to the business, and that's measurable as well, then you can give them up to £5,000 tax-free in 1 year. Now, I spoke to a company about this recently, a tech company, and the MD's eyes just lit up. He ran off shouting, "You just saved me 50,000. And I had to say to him, "Easy, Tiger, not yet, calm down now." But he really got that, and he's looking to implement something like that, because for him, it gets people to think, and think positively, not just be robots in the business. If they come up with an idea, again, they change the business. And this comes back to this whole thing about tax and growth. It's not just about corporation tax rates or things like that. It's about changing behaviour and rewarding certain behavioural patterns in a business with a tax perspective on it that does change the business itself. The final one is cycle to work, which can be quite handy unless you live in parts of Wales, in which case it's probably not so wise. A, weather, and B, lots of hills. But cycle to work is still around. It still works quite neatly. I have to say that not all staff actually do cycle to work with their brand new carbon fibre bike, but you can do it. You can just about get a carbon bike for under £1,000, which is the limit. Again, though, it's something which can be quite useful if the pattern of your staff is correct. A small story here, my wife, I ran a business, she got a cycle to work scheme bike, I think she used it twice. If anybody from the revenue are here, sorry, she used it all the time, really. I mean it. But it can be quite good. You do have to use it though properly, otherwise you are at risk of having the whole reward pulled back. So that's the cautionary note just to mention. Pension contributions 2 or 3 years ago would not have been something I would put on this slide, because at that point in time we were all over the place with pensions. The government kept changing the rules all the time, you didn't know what to do. They restricted reliefs on contributions, but actually for a lot of owners, having a steady stream of pension contributions into, say, a SIP, a self-invested pension plan, can be a brilliant way of just storing up value. You get tax relief on the contribution, you get tax-free growth, and now with the changes recently, which have transformed things, the punitive tax rates on exiting money out of a pension scheme have fallen away to some extent. So a classic scenario here would be an entrepreneur looking at the premises that they have and setting up a SIP to buy the premises, renting that to the company. Company gets a tax deduction, the rental income stream is tax-free. There we are, that works quite nicely. And you're not worried about a tenant, because you are the tenant. And that's a tried and tested route to extracting cash. So there are other reward schemes for employees and for the owners of the business themselves. I'll briefly look through capital allowances, largely because this has been around since the dawn of time, or for quite some time, and it's a well-trodden path. But we have a curious thing where if you have a capital-intensive business, then we're losing the benefit of capital allowances. Tax rates have dropped, which means your tax relief drops, and the rate of allowances have also dropped as well. So for capital-intensive businesses, it's not good news, and to counteract that, we've got this 100% allowance, the annual investment allowance itself, which gives you effectively a revenue relief against any spend in any one tax year. Timing is quite important as well. You don't necessarily have to buy the asset to claim the tax relief. So if you order an asset before the year end, and you unconditionally entered into that contract, that's the point at which you can claim allowances. You may not even book that asset in your accounts for that year. It doesn't matter. For tax, you get the relief when you order that asset. And that can be quite good. As you can see, the rates, 18 or 8% compared to 100%, doesn't really stack up. So you get the 100% whenever you can. Great for property businesses. Any property that you've got to get capital allowances sorted on that. It does make a huge difference. And I've been looking recently at somebody who built a hotel and we're looking at 40 to 50% of the cost of that whole hotel as qualifying for capital allowances. That makes quite a difference. I did a little spreadsheet for them to switch on and off the allowances over 10 years. And the client wasn't really fussed about allowances. And I gave him the spreadsheet and said, right, hit that button, go on, do it. And he did it. And the difference was £2.3 million in tax. That got his attention. So there we go. If you're advising, get a spreadsheet, show people with an on-off button. It really works. Here is a lovely graph. This is not a diagram of a Lego brick, but it demonstrates that we've got this blip in annual investment allowance, this great big high part. That's where we are just now. Now you imagine if you've got 100 grand to spend that's due to happen next year, and your allowances at that point are about 25,000, you just accelerate that slightly into the current year, get your 100% relief, job done. So timing and planning ahead, which is always part and parcel of any tax strategy for growth, is quite important, and there's a good example of that. Thinking about growth and planning for that ahead of the anticipated growth itself, or investment. Restructuring, just a couple of things on this. This is where you're getting to a point where the business is of a reasonable size, and you're starting to think really about what the constituent parts of your business are, and whether there's opportunity to be had in moving that or restructuring that to enhance value, to perhaps separate out clear income streams so that they're quite visible. That may help with funding, for example. But it also allows us to do things like some tax bits. And if it's a family business, it also allows us to consider family interests as well. Cross-border, I won't talk too much on this because there will be a presentation at noon by one of my colleagues on international trading and international tax. Rajesh, I believe, is doing that, and he's a good guy, good speaker, so worth listening to if that's relevant. International is all about, though, creating or avoiding the use of a tax footprint in a country with a high tax rate. So we try and make sure all the risk of any business, and therefore all the reward, or most of it, stays in a jurisdiction that has a low tax rate. And the UK is pretty good for that at the moment. 20% from next year, that beats every one of the G7, and it's only countries like Ireland that are lower than us. We've seen a lot of companies return from headquartering their businesses in Ireland back to the UK because of other non-tax advantages, and it's something worth considering. So cash extraction, something that just makes people's eyes light up. Whenever I speak to entrepreneurs or business owners, the first question they usually ask is, how do I get the money, how do I get the dosh, the watch, out of the business itself? Well, this is how we do it. You've got the standard stuff. Do you pay yourself a bonus or a dividend? For the last 5-6 years, it's all been about dividend. That is cheaper by something like 7%. The effective tax rate is 40%. Usually compared to about 47%, which is the cheapest you can get cash out. But actually, that's the naughty stuff. That's your Duplo to the Lego or to the Meccano that I'm about to talk about. A way of getting money out, but advancing it, is to use loans in conjunction with dividends. And now you take a loan out at the right time of the year. You have to repay that loan at some time, otherwise the company has to pay a bond across the revenue, 25% bond tax. But that gets repaid back to the company when the loan gets repaid. What you do with this is that you structure the timing of the loan and the dividend that effectively cancels that loan out, and you can defer tax up to 3 years by doing this. Straightforward, doesn't upset Margaret Hodge or any other MP. It is well within legislation, in fact comfortably within it itself, and for that reason it is safe. And that's one thing that's important about tax, is that the more complex you make tax, the more risk you have of things going wrong or of legislative change. Keep it simple. It's like electronics. Try and simplify it at all times. You then get something that works and doesn't cause commercial ripples. This is one that just keeps the water absolutely flat, calm. It's very easy to do, and it doesn't impact at all on the commerciality of the business. You can also use loans if you're anticipating a company's sale. If you're, say, 3 years or so out from a sale, 2 to 3 years out, you can effectively borrow money now, and again, if the timing is right, then what happens is on sale, that loan is effectively repaid by the sales proceeds. But the effect of that is that you're getting cash now, and you're paying tax at 10%, so you're almost banking your future tax rate or capital gains tax. Again, it's something that can be quite useful in the right circumstances, but you have to be looking at a sale in mind, otherwise it's back to the previous one, which is a deferral of tax and not a rate change. Company share buybacks are still there. We forget about these. This is almost old-fashioned stuff, but if you've been a shareholder for 5 years or more, and the circumstances are correct, you can have your shares bought back if there are sound reasons for you actually reducing your holding, and that should get you a 10% tax rate. We go for clearance with the revenue advance. They are getting a little bit suspicious. The clearance division and the revenue are paranoid. They think everyone's out to get them. And there is a slight lack of commerciality where most of the revenue, in fairness, are pretty good now. They are pretty commercial. But this division that deals with clearances still think the default position is you're trying to fleece them, which is unfortunately a consequence of some things that have happened in the past. But if the circumstances are right, you can do a share buyback, somebody can exit and get their 10% tax rate, which is, I would say, an acceptable solution. You can also sell part of your business as well. When I say part, I would say this as an important point. If you're not giving up control of the business, it's unlikely you can get cash out at capital gains rates. The revenue would look to tax that as a dividend, which could be up to 30.5%, so not so good. Give you an example. This is an example of what I would call the end of the growth phase, where you actually want to sort of sell out or get cash out or transfer perhaps to the next generation. Here's a case where the parents have built up the business, they hold shares in the company. The next generation, the children, are going to actually inherit that company and take over. But the parents won't just give that to the children, the parents want something out of it. They have been working 30 odd years to build this company up, they want something out. And they want the children also to be effectively geared up slightly so that they are driving the business as well. There's a good reason for them doing that. So we'll do that by an internal funding exercise, which has been the case for the last 3 years in the absence of external funding on deals like this. It's been an internal funding thing where the deal is done by future profits paying for the exit. Now what that does is, if you get it right, and if you do actually give up a controlling interest, it's 10% on cash extraction. The company itself is also tidied up for inheritance tax, which we forget about. If you've got a big pile of cash in a business, that kind of wrecks it for inheritance tax. Now, if you're in your mid-40s, you probably won't care about that because you're immortal, you carry on forever. IHT is something on death. I don't want to think about that. Don't talk to me about death, talk to me about growth. So nobody thinks about IHT unless they really are quite old and then they're getting slightly worried, but it's still an issue that needs to be considered. This also gives a very useful way, though, of handing over the business to the next generation and for that family to carry on growing the business itself. At last, a diagram, no more bullet points. Right, here we go. We've got series here, the new, the old generation. We've got a new co that's going to acquire the shares of the trading company itself. And here's a bit of background. So we've got some earnings, which will give rise to a value of about £2 million. But we've got some cash in there as well. So we value it at 3.6 million. Kids set up new co and they'll buy the shares out and they will pay some money out, which is the existing money in the business, and the rest of that will simply be paid by the future profits. So the excess money comes up from the trading company up to the new company, then out it goes. And it looks something like that. That's how the balance sheet would look. So at the end of it all, the shareholders get some money. After tax, they get about £1.9 million for selling their interest. They've still got a shareholding in that company, and it's important to point out that this example says 40%. That's about as much as you can retain. Even at 40% nowadays, that's slightly on the risky side. The revenue really do look to shareholders stepping out a lot, a really fundamental change of ownership. Otherwise, it's going to be a problem for them and they may deny clearance. But the children then get a company that's cleaned up, the parents get some money out, and off you go, you trade on, and you've got that indebtedness still in there, which keeps the kids focused on continuing the generation of profits. Some tax planning for sale. Get the shareholdings right before you actually sell. Really important. Sometimes you forget and it's too late. 1 year before is where you're thinking about things. That's one of the trigger points to transfer shares around, because that will help the shareholders with their tax position. And get the structure right as well. Get non-core assets out of the way. The amount of times I see a deal where the property's in there and it's not wanted by the acquirer and it's too late to think about it. I've just seen one recently where they did a deal and I could have saved them £100,000 by getting that property out in good time. So unwanted assets need to be divested early on before you sell the business itself. Also clean up the company. A lot of people went into dodgy tax schemes 3, 4, 5 years ago. They were being flogged and sold mercilessly by small accountants. they're still there, still causing problems. Take them out of the picture, otherwise an acquirer may not say yes to that business itself. So clean it up in advance and demonstrate you've done that. So a quick summary then. It's been a quick run through, but you've got lots of issues as a growing business, but you've got to think about tax as one of these tools that you can use to actually help the business grow, to remove obstacles, and to clean the company up for any future exit point. And it's never just for the company. The tax I've talked about is the owner and the company, and they are intertwined. And that's the key thing about an entrepreneurial business. They are one and the same, and that should never be forgotten when looking at any solution. Think in advance. It's not always easy. You're frantically busy running, getting orders, dealing with sales, worrying about IT, but just sitting back at times and just looking ahead, 6 months to 12 months, can really help give you that visibility, and it will save you money and time before it hits you in the face. And I think we're there. Any questions? Dazzled you? Or soporific? Killed you off. There we are. So now I've softened you up. Melissa's going to take care of you after this one. So I think I'll be around for a while yet to take any questions if you want. Otherwise, please do come back at 11:15. Thank you very much.